Dear clients, I'm Richard, a Phillip CFD dealer. In today's weekly market commentary, we recap on some market actions and events calendar that have kept investors preoccupied in an otherwise muted week in terms of equity performances. To put things in perspective, stocks have soared this year, putting the S&P on track for the biggest gain since 2003, after companies reported higher than estimated earnings and the Federal Reserve maintained its stimulus plans. As we entered the first week of November, it is also interesting to share that the S&P's return has been positive over November and December every year since the start of the bull market in 2009, according to Bloomberg. However, after rising to new highs, equity markets are taking a pause on renewed uncertainty regarding the timing and scope of the US Federal Reserve plans to taper its asset purchase program. Trading volume was relatively light as investors were reluctant to make big bets, with the S&P index just below the all-time closing high. This week's quiet activity was partly due to investors staying on the sideline ahead of the all-important non-farm payrolls report due on Friday for further clues on when the Federal Reserve may begin to start tapering stimulus. At this juncture, clients may want to take note that, according to a Bloomberg survey, the US added 120,000 jobs in October versus 148,000 in September and 193,000 in August. In Asia, the MSCI Asia Pac ex-Japan Index is also poised for the longest stretch of losses in more than 2 months before China leaders meet in Beijing on 9th to 12th of November to discuss a blueprint for reform as the country heads for its lowest annual growth in more than 2 decades. Some market participants caution that the market may have priced in a fair amount of expectation about market-friendly reforms, and therefore, from a tactical standpoint, the market could be vulnerable. Signs of taper tantrum are likewise displayed in the cross-asset markets. For instance, the US Treasury 10-year yield has rallied and reached the highest level since October 16th, as the US services sector grew faster than expected last month, underpinning speculation the Fed may move out the timing of the asset purchase cuts. In this respect, clients may want to take note that the next FOMC meetings are 17 to 18 of December, 28 to 29 of January, and 18 to 19 of March respectively. Similarly, in FX market, the US dollar, after falling to its lowest level since February against major peers, is attracting the biggest wages by money managers in almost 5 years on signs the US economy is gathering pace. According to Bloomberg surveys of economists, growth in the US will accelerate in every quarter of 2014, starting at 2.6% and building to 3%, while in the group of 10 overall, it is forecast to be about 2% for most of the year. A strong economy may keep US inflation levels higher than other major nations, allowing the Federal Reserve to lead the world in reducing monetary stimulus that weighed on the greenback. Amid this macro uncertainty, we believe that the rebound in global manufacturing supports overweights in cyclical stocks in terms of positioning within the equity space. The stronger than expected showing of recent US factories data and the ISM manufacturing report last month, amid the fiscal drag and distortion of the 16-day partial government shutdown, reflects the resilience of the US economy. To further illustrate the cyclical appeal, in China, growth rebounded nicely in the second quarter, but continues to be led by investment and infrastructure spending, rather than consumer spending. Some similar trends are also seen in Europe. In Spain, for example, the economy is growing modestly, but is being led by exports, while the unemployment remains close to record levels. In general, cyclical companies are cheaper than defensive ones, and they also stand to benefit more from any improvements to the global economy. You may consider using contract for difference, CFD, to trade different markets using flexible strategies, both long and short, at a fraction of the capital required by traditional trading. You can also trade using many more benchmarks based on different strategies that are available via ETFs with Phillip. That's all for today, and hope you can join us in the next round of market commentary. Thanks for watching.